Run with Chestnut.
All right, this is Run with Chestnut, episode number 9, and this is the first installment of our, what are we going to call it, Simon? Investment hour?
Yes, investment podcast.
Investment extravaganza. Basically, a intro series, a mini series that will span like a few episodes, all about the basics of investing, like what's a stock? Should you even invest?
Yes.
How do you get started? What do you invest in? Do I want to buy Tesla stock right away? Like it's everything. Well, and Simon's a total beginner, which is awesome because that means he'll be like, as we walk him through it, we will potentially answer all the questions that will come up. A quick disclaimer: this is not personalized investing advice. Don't listen to what we're saying. We're just two dudes on the internet who know nothing about anything. Do not listen to us. You are insane if you do. Okay, cool. Now that we've all established that you're insane, let's get started. So Simon had a little homework, right? So you looked up what 3 things were, right? What were those 3
Stocks,
things?
bonds, and mutual funds.
Cool. So let's. I feel like that's the where to start, right? Like,
yeah, let's just dive in.
I feel like a lot of people don't even know what those things are. So let's define those things, and then we'll get started. So, what's a stock,
A
Simon?
stock is basically an ownership of a part of a company. And there are 2 ways that you can make money off of stocks. You can make money off of stock appreciation and how do you pronounce that? Dividend.
Yeah.
Dividend. Okay. Dividend.
Yeah. I'm sorry, it's hilarious. Oh my god. Okay. What is appreciation, first of all? Not even stock. What is appreciation?
Appreciation is
like liking what I do.
Wow. Appreciation is basically whether or not the value goes up in something.
Yeah. And so what's the opposite of that? Depreciation.
If it goes down, the value is going down.
Okay. So stock appreciation
is whether or not the stock value goes up or down. And the way you make money off that is, say if you have a company and you invest the stock costs, say, $20. And then say the value of the company goes up, the price rises to $40.
That's a lot of damn, bro. That's a high mark.
Granted,
it's 100%. Okay, no, that's good. I like it. Be bold. Okay.
Normally, it doesn't go that high, and so if it rises up that high, and you decide to sell that share of your share, you would be making a profit of $20.
Right. So to use your previous language, if the stock appreciates from $20 to $40, you sell it at $40. That means you made a profit of $20 minus any sort of capital gains tax that you need to pay. And taxes is a thing we can get into another time, but do not forget about taxes.
Right.
You pay taxes on anything you make in the markets with a few asterisks, which are mainly around retirement accounts.
Right.
But in like a regular, okay. But we'll do like a thing on taxes.
Yeah.
Cool. Okay, that's and then the second way you make money, dividends.
Dividends, from what I understood, is the company paying you a share of their earnings.
Yeah. Okay. Well, let's not use the word share because that could also mean like a share is a stock, right? So let's it basically pays you a percentage of earnings. It gives you like a little cut, basically. So like if you have like a 4% annualized dividend or something, send like a $20. What's that like divided by 5? Blah blah blah. So I can't do math.
$20. 20 divided by 5. That's
no. 4% of. No, this is embarrassing. Okay, 80 cents.
Okay.
Like, good Lord. Yeah, and basically, and it's usually paid out in either quarters. Usually quarters. I'm trying to think of other examples, but and it just shows up in your account, and it's basically this is cash that you can either reinvest in the stock or just get as cash.
Right.
You know what I mean? So that say like the $20, you own that. Instead of it going up from 20 to 40, you have to selling it. You don't ever sell that 20. You just get those 80 cents as the 4%. And then, dividend could be from 1%, 10%, whatever. Cool. Next thing. What's a bond?
A bond is owned by the government. And so it's basically if a company wants to make money, if I get this correctly, they get the money from the government. And
no. So, super simplified, right? A bond is just it's just debt, basically. And you can have a government issue a bond. You can have a company issue a bond. You can have like a local municipality, right? Bond is just like a vehicle of debt. And so basically, if I buy like the most like a very, very popular thing is like the Treasury bond, right? The U.S. Treasury is the federal government, like prints money, blah, blah, blah. If I buy like a bond, say, and bonds are generally safer than buying stocks, but your return is generally a lot less because it's safer. Usually the safer something is, the less return you get. Right. And so if you get, say you put $20 into a bond, it's like a really low amount, but whatever. Say you put $20 into a bond, and if you hold that bond for, 10 years or something, and then you get a certain percentage of it as like a, thanks for holding it kind of thing. You know what I mean? You're basically lending your money to someone, and you're collecting kind of like interest payments on that loan. If I think like a lot of people are familiar with student loans.
Yes.
It's kind of like student loans in the sense that you're lending someone money and they're giving that money back to you with some interest on it. It's kind of like that. And that's safer than stocks, but there's also the risk that
the person might not be able to pay it back.
Exactly, if they don't pay it back. And obviously, like the chances of the U.S. government not being able to pay it back is probably pretty low, right? But if you get like a municipal bond, or you get like maybe not municipal, let's say like a company, like a private bond issued by a company or corporation, maybe that risk is a little higher, you know. So that's another thing. Because
companies can go bankrupt. So
okay, cool. And the last thing,
mutual funds are basically they're basically kind of like a bucket of all different types of investments.
Yes, and that could be like a super broad. It could be like a mix of different stocks and bonds. It could be different. You know what I mean? And there are actively managed funds. And we'll just put like a fund as a title, right? They're actively managed fund, and then there's passively managed funds, similar to like an index fund.
Yes.
Which, for example, an index fund, popular example. Okay, an S&P 500 index fund. So an S&P 500 is an index that follows 500 companies. And so if you buy into an S&P 500 index fund, you're basically buying a small piece of each of those 500 companies. So it's a very, very like safe way to invest without having a lot of exposure to a single company.
Right.
And the difference between like a passively managed fund like that and then an actively managed mutual fund is basically an actively managed one. You actually have a human being deciding, okay, all right, let's buy this thing, let's sell this thing. Like they're actively figuring out what companies are in the fund.
Right.
And usually you're going to pay a fee for that service to have an actively managed thing, and you can see the fee. The fee's usually like anything from Fidelity has zero.
Right.
Have zero fees all the way up to like a percentage or 2 or something from different places. So cool. Okay, that's like basics. How'd you find this out? Did you just like Google?
I Googled, and then there's a channel on YouTube I came across with it from TD Ameritrade.
Oh, cool. Do you know what TD Ameritrade
is? Is it part of TD Bank? And
very perceptive. It is the investment banking arm of, or was the investment banking arm of TD Bank. I'm pretty sure TD Ameritrade was acquired by Charles Schwab, which is another investment bank. But okay, that's a perfect segue into our next discussion, which is basically how do you even invest?
Or rather, or even before should you even invest?
Okay. Should you invest, Simon? Tell me.
Well,
who should invest? What should you do? Like, what are the questions you need to ask yourself before you invest?
Do I have credit card debt? Do I have enough yearly expense of living? Basically, if something goes wrong, do I have enough money saved that I can live off of a year? And yeah, is there one more?
Those are two good places to start. Yeah. Let's start with credit card debt. Why is that question important?
Because if you have credit card debt and you constantly have to pay it off, then
Simon's thinking.
Wait, actually.
Simon's thinking. I'll give you a hint. It's about interest.
Right. So when you have credit card debt, the amount of interest that you have to pay off increases the longer you wait to pay your debt.
Yes, but also, credit card debt generally is extremely high interest debt.
Yeah.
It's not cheap debt, okay? If you have a mortgage of a house, or you have a student loan, or you have, a car loan or something, usually as long as your credit score is pretty good, that debt interest percentage, APY on that interest, on the debt is super low. Right? Like when I had student loans, my credit card debt was like 2.78% or something like that, 2.75, like super low interest payments, right? Credit card debt often is in the 15, 20, 25% interest. That's a lot of interest you're paying, right? If, say the markets, right, on a regular market, which right now is not a rational regular market, but most of the time, you can expect to make an average annualized return of 7, 8, 9, 10, maybe higher than 10 if you're doing really well, percent return, right? Which means, say 8%, okay? If I'm making 8% on my investment within the markets, which is like super, I don't think that's super hard to do. If your student loans, the interest on your student loans is set at a 3%, then you do 8 minus 3, right? That's 5%. You're basically making a 5% profit. Generally speaking, right? Like if you're trying to think like, where's my money best spent? Right? Which is why if you have student loans, yes, obviously it's better to pay those down, but it's not as crucial to pay those down quickly as it would be if you had a 20% interest rate on something debt, right? That's what you call expensive debt. Where like it's really hard to continuously make a 20% return in the markets year after year after year. Which means you will actually end up making more money by paying that debt down than you would by investing your money and saving your money.
Interesting.
So if you have high interest debt, you will actually make more money by paying that down than you would by investing your money. You know what I mean? Which is why, like Robert, whatever, Kiyosaki, or the guy who wrote like Rich Dad Poor Dad, I'm pretty sure, I'm completely butchering this, but I'm pretty sure like one of his major things that he tells everyone is pay down expensive debt, which is like step one.
Okay.
And again, if you have like long-term debt, like a house mortgage, that's like literally like 2-3% or something, that's not the same thing. That's not expensive debt. That's cheap debt.
Right.
Okay. So, okay. What was the second thing? Emergency fund. Super important. If you get hit by a truck or something like emergency happens, you have a kid or something happens, like you should not need to sell your investment, right? You should have like a cushion.
Of that money.
And it differs. Yeah. Like what did the place that you looked at, did they give you a time frame?
No.
Generally speaking, I've heard anything from like 3 months to 6 months.
Well, they said a year. Like you should have enough money for a year.
Okay, I think this differs depending on your age. And so does investing, which we'll talk about later, differs on your age. I think the older you get, the bigger cushion you want. You know what I mean?
Right.
If you're in your 20s, I don't think you need a year. Especially if you're like, I mean, let's put it this way. I think it's nice to work up to that, but I feel like your life as a young person is so fluid that you shouldn't wait until you have this massive amount of cash pooled away to even start investing. You know?
Right.
Versus if you're like a year from retirement and you don't have like a year's wage, like living expenses saved up, maybe that's a different thing.
Right.
You know what I mean? So I think it's age is part of it. A good balance, I feel like, is 6 months. Basically, you need 6 months of cash to pay, you know, all your expensive food, rent, gas. I don't know what else, whatever else you want, Netflix, like electric, like, you know, just if the world turned upside down and you stopped getting income, could you survive for 6 months, basically?
Yeah.
Without selling your assets or investments. Right. And I think that's an important thing to establish first. So pay down expensive debt and have it's properly called an emergency fund. That's liquid. Liquid meaning cash, like in your bank account, not in your mattress.
Right.
That's another thing. If an investment person tells you cash, they don't mean like literally cash, which I thought I found very confusing when I was first getting into investing. I kept hearing about, like, what's your cash to investment ratio, or like cash and cash, you know, like every time I hear cash, and I'm just picturing these like old dudes sitting around like their living room with like cash stuffed in the couch. Like, that's, you know what I mean? Like, cash just means like money in a savings account or in a checking account or in your investment account that isn't actually in the market.
Right, okay.
So that's what cash
Got
is.
It.
Cool. So if you have those two boxes checked, then we've decided, okay, it might be in your interest
to start investing,
right? Cool. How do you start investing, Simon?
1 second. Hold on. Okay, sorry about that.
Oh, Simon's doing something. No, it's all good. I think you talked about TD Ameritrade.
Well, right? Yeah. So TD Ameritrade. What I read is looking for a broker.
Yeah, exactly. So a brokerage account will, or any sort of like investment account is is the platform that you invest in, right? And I think the most popular ones are, you have like these app first, like super kind of trendy platforms such as Robinhood, Weebly, Vanguard. Well, no, sorry, not Vanguard. I'm trying to think. Like, you know, basically these apps that have like zero fees, and it takes you like a minute to sign up, and you get these free stocks as a bonus of signing up, which is cool, right? The other thing are like more the investment backed sides, such as Fidelity, Charles Schwab, TD Ameritrade, Interactive Brokers, stuff like that. Whatever you choose, I mean, they're all pretty much the same, honestly, or very similar. What you should look for is free trading, as in like zero. Like, you should not need to pay a fee to buy a stock.
Right.
Which most of them don't have anymore. I use Fidelity, but that's just because I like Fidelity. Like, I also have a Robinhood account just to mess around with. I think you have Robinhood, right?
I do. Yes.
You have it, yeah. You know, it's as long as it's zero. Like, I for example, a lot of these apps, like, they'll give you like these features to you can like look up this sort of statistic and have these sort of charts. It's cool, but honestly, like, most of my research is done outside of the brokerage anyway.
Right.
That as long as it's a reputable place that you don't need to worry about, like, if there's a market crash, are they like is my money going to be okay? Like the thing I found a little sketchy about Robinhood is that they've had like multiple blackouts where it's like you can't log in for like a couple hours.
Okay.
And the fact that they have no physical locations, just kind of weird. Like, I like to be able to walk into a physical Fidelity location and you know what I mean? It just
talk to a human.
Maybe it's psychological. Exactly.
Right.
Maybe it's psychological. I feel like my money, especially if it's like a lot of money you're saving away, it's safe.
Yeah.
You know? So first you need to pick one of those.
Yes.
When in doubt, I mean, again, it's not sponsored or anything, but I like Fidelity. Fidelity's pretty cool. is totally free to sign up. Like no fees. Like I don't like I've been with them for a long time. I did a lot of things with them. I don't think I've ever paid a fee. Like you can do most of your, Second thing is choose what kind of account. And that's basically, do you want a retirement account or like a regular brokerage account? Right?
Okay.
Did you look up anything about that?
No.
So here's the argument, right? And you tell me I'll tell you my reasoning. You tell me what you think.
Okay.
Because there's some controversy around this. Basically, the only difference between any of these accounts is taxing, is like the way they're taxed. That's the only difference between a Roth IRA, an IRA, a 401k, a brokerage account. Like that's the only difference, taxing. Right?
Okay.
And a 401k, a Roth IRA, an IRA, all those three, I mean, and there's a lot more than that, but like those are the most famous three are retirement accounts. Meaning you put money in, and as long as you take it out after you turn age 59 and a half, you skip out on some taxes, which means you don't have to pay certain taxes.
Okay.
Hence, they're called retirement accounts. They're meant for your retirement. Like you cannot, if you try to take them out before you turn 59 and a half, there's a lot of fees and penalties and blah, blah, blah. And the other option is a regular brokerage account, which you can put money in as much as you want, anytime you want, and you can take money out as much as you want, anytime you want, regardless of what age you are. The downside of that is that you pay taxes, more taxes than you would pay on a retirement account. And so the controversy comes where people tell you, just like, investing should be long-term. Therefore, plan for your retirement. Try to max out your retirement accounts first, and then put whatever's left over in your brokerage account. The other side of that coin, which is kind of the side that I sit on,
you never know,
especially for younger folks.
Yeah.
For people in their 20s, even 30s, is retirement's like
way ahead.
It's like 40, 50 years away, right?
So
it's like, why would you penny away all this money into these accounts that you are not allowed to touch for 40, 30, whatever years?
Right.
Unless you were close to retirement, right? We're talking, if you're close to retirement, then by all means do it. But if you're far from retirement, it's like you have no, like, what do you want? What do you got to buy a house? Like, what do you want?
Yeah, that's what I was thinking too. Right? I agree.
And so I view, and like, yes, you have to pay a little bit more taxes, maybe like, depending on your income level, maybe like 5-10%.
Right.
More taxes than you would, maybe 15, depending on how much money you make. I view that extra tax as the fee of having the flexibility of being able to take out my money pretty much anytime.
Yeah, that makes sense.
Yeah. And again, we can go into the we won't like go too much into it in terms of the differences between all the different retirement accounts, like 401k, Roth IRA, blah, blah, blah. We could go to another time. And also, it's pretty easy. Just Google differences between retirement accounts, right? It's pretty easy. Generally speaking, the only thing that differentiates all of them is basically how they're taxed.
Right.
And for me, I'd rather have the flexibility of knowing if I wanted to, I could take out the money whenever I want it. Not to say I don't, right? It's not like I don't do it, because the whole goal is to save more and build wealth and all that stuff. But like, if I needed to, I wanted to know.
Right. Makes sense. I agree. Yeah.
You know what I mean? Like, what are your
No,
thoughts?
I agree. Actually, I knew where you were going with that, actually, because
freedom, man. Like, and like, okay, if I got to pay a little bit more for that freedom, sure, go for it. But yeah, okay, cool. So now you've decided on the platform, say like Fidelity.
Yes.
And then you decided on what type of account, say like a brokerage account, or okay, if you want a retirement account, if you're like 50 years old or something, you want a retirement account, go for it. Get a retirement account. You have the account. Now, what do you do?
Well, I'm guessing that
within that
you decide account? Whether you want to invest stocks, bonds, and how.
Okay. What are your thoughts? Stocks or bonds?
I think it also depends.
Or I should say, sorry, let me interrupt you. Stock, bonds, or funds.
Right. It said something about what's more risky, and I feel like someone told me that it depends on the type of person you are, and if you're younger, if you're willing to take more risks, then you should invest in stocks, because people believe that the more risks you take, the more chances you are of getting a great return. Or if you want to go more safely, then you can do either bonds or funds. Am I correct?
Yeah. So generally speaking, well, risk just means the potential for it to move faster, right? Like higher volatility.
Right.
Now that could be move faster,
Or
higher,
lower.
or lower.
Yes.
Like it could be either
Yes.
one, right? And so as a younger person, you're more durable to that type of volatility because you have more time for things to recover if things were to go bad.
Right.
You know, like if you're 55 and you're a few years from retirement, and like and you plan on retiring,
Yeah.
or let me not even give an age. If you are close to whatever age you want to retire at, you probably don't want to be 100% in stocks unless you don't need that money, right? Like if you have enough money to live on that you don't need to start being like selling your investments, then that's a different thing. But if you're going to need your money in the next 5 years or something or less, you probably don't want to be totally in stocks. Versus if you have time, and especially if you're young, like stocks, man, that's all, you know, I mean, we sound like kind of biased, obviously, but the idea of like owning part of a company and watching it grow
is kind of cool.
Is cool.
Yeah.
It's super cool. And I mean, okay, I think anyone who's into investing needs to know who Warren Buffett is. Do you know who Warren Buffett is, Simon? Oh, you're hurting my heart. Okay. Warren Buffett, not to be mistaken with Jimmy Buffett, the singer.
I don't know who that is either.
Do you know Jimmy? You don't know Jimmy Buffett either? Oh, okay. We're gonna do some music listening later. Warren Buffett he is the most famous investor that is alive. Okay, I don't remember exactly how old he's like 90 years old, 91 years. He's old. He's an old dude.
Oh wait, I think.
Okay, he's still alive right now.
This, yeah.
Yeah. His company that he runs still to this day, like he still works there. He's still the head, like the CEO or whatever, is called Berkshire Hathaway, and like a lot of people like quoting him because he has a lot of like, you know, famous things that he says because he's like 90 and he's worth hundreds of billions of dollars. Okay, so he's like, he knows what he's doing. And the thing, the one of the pieces of advice that he tells new investors is, don't think of stocks as numbers on a graph, right? Think of it as buying a piece of an American business that you literally own part of that business.
Right.
And that helps you get through a lot of volatility. And that helps you it helps you better pick stocks to even invest in the first place. Because it's like, do I want to own part of this company? You know what I mean? I don't know. It's a mindset shift if you go from thinking about a stock as just a number and a name
versus
to thinking of it as owning part of that company. Yeah. Which, like, okay, maybe if you own one share, it's like you own 0.00001% of the, like you own barely anything.
Right.
But you still own part of the company, you know? So it's I don't know. I think it's a super cool thing. Cool. And so to the original question, stocks, bonds, or funds. Bonds are pretty safe, very low on returns. Funds are a little less safe, and you get a little bit more of a return. And it's generally because you have a wide basket of stocks, you have a more like regular return. You know what I mean? Right. A company might have like -20, +20%, and +10. Like it might be all over the place. A fund, generally speaking, will be pretty smooth. It'll have like little dips, but pretty, you know.
But because also you own so much of so many different shares, so many different companies. If one company goes down, then you don't really notice it as much. So
exactly, you don't really notice it. But by the opposite of that, if one company absolutely explodes and does amazingly, you also don't really notice it either.
So
because it just kind of averages all out. So basically, this is what I like how think about it to when I tell people. If you don't really if you kind of want your investing to be autopilot, and you don't really want to worry about, like looking at a balance sheet, which again we could do an episode on in the future, like looking at the financials, the income statements, the debt, the equity, the liabilities, all these different things, and trying to figure out, is this company investable?
Right.
Like if you don't want to do all that, if you literally just want to be a lazy investor, which I totally get, invest in funds.
Right.
Because you'll get an annualized return. Like, what do you want? Like dump your money in a savings account that'll give you 0.03% interest, or do you want an index fund, which is almost as easy as dumping your money in a savings account, but it'll give you 7, 8, 9% every year,
right?
Repeatedly. You know what I mean? It's just like it's the savings accounts version of investing, basically. You know what I mean? Like, kind of brainless.
Yeah.
Which in a good way.
Yeah.
And it'll just give you this consistency, and then you don't have to worrying about a specific company, like, this new trade agreement that the U.S. is signing with China. How will that affect the supply chain of this company that has parts, manufactured in this factory in China? Like, you don't have to worry about any of that.
Right.
You know what I mean? It's just, it's broad. Did you by any chance look up any individual funds?
No.
Or types of, okay. I would, and again, we can get into more details in a future episode, but I would say, for anyone that's interested, a very, very like common spread of funds is, and if you're a member of Fidelity, Fidelity has zero fee funds. It's called like the zero cap series, something like that. It's called like zero total market, zero S&P 500, and zero emerging markets, something like that. I don't remember, but basically the name of the funds have zero in the front of them, implying zero fees. If you just buy one fund that tracks the entire market, one fund that tracks, like maybe like the S&P 500, which is, like that index, right, of 500 companies that you hear on TV all the time, like, oh, S&P 500 got, 300 points higher today or less, like that thing. And a fund of emerging markets, which is basically non-U.S. stocks, like international stocks. If you just get like a sample of those three, that's a pretty wide spread, dude. I mean, honestly, even if you only got one of those or two of those, it's pretty good. You know what I mean? And you can see the past performance of those funds too.
And those funds could even be like any other company, like Apple or Amazon.
Say one more time?
Those funds can be also from Apple or Amazon or things like that.
No, but again, remember, so these funds contain all these different
companies. Okay, right. We're talking about funds. Okay, yeah. Right.
We're talking funds. Index funds.
Okay.
Like a low fee or zero fee index fund. Like if, for example, I don't own any index funds.
Right.
Because I like stocks or whatever. If I were to invest in index funds, I would probably invest in like a total market index fund, a zero total market index fund, and then one that tracked like the S&P 500,
right?
Let's say, so that's like the less work, but more return than bond sort of option, right?
Okay.
And then for those who actually want to buy companies or stocks, I don't know. What are your thoughts, Simon? Not necessarily what companies, but like what questions, like what would you do?
If I wanted to buy a stock, you mean?
Or just in general, like say you got some money and you have a brokerage account. What would you put it in? Funds or companies?
Right now I would do companies.
Why?
Because even though I know that, funds can be more passive and it's a lot more brainless. But if you do companies, I'd probably have to work harder at following, their, what would you call it? I guess rates,
or
performance rate.
Right? Yeah.
I know that right now, at the age of where I am, there's still a greater risk that I can probably make more of a return. Whereas later on, like if I'm older, then I could probably do it more passively. But
so you're saying because you're younger, you're more willing to take on that risk. Cool. I completely agree with you. I would say, like, where would you start? What companies would you start? Do you have any ideas, or you?
I have no clue. I don't know what any company's performance rate is. So,
well, don't worry about. Well, first each just perform not right. But no, this is good, man. Total beginner. I would say the same thing to someone newly getting into investing, as I would say to like kids who are trying to get into investing, is that I think the best way to get it started is pick companies that you know well and put a little bit in them, and then just start following them, start tracking.
Right.
You know what I mean? So like, give me 5 companies that you know well.
Apple, Netflix, Amazon, Thrive Market, Hulu.
That not public.
Wait, what?
Thrive Market's not public.
Oh, okay. I did not know that.
And Hulu is owned by AT&T?
Okay, so
I don't... I could be completely wrong. Hulu's owned by someone, and I thought it was the same people on HBO, which is AT&T.
Oh, okay.
I'm pretty sure that's what it is. Like, don't quote me on
it.
Okay. Let's say AT&T. Let's assume, for argument's sake, AT&T owes Hulu. Right. Okay. So give me a 5th one. You say Apple, Amazon, Netflix, AT&T.
AT&T. What else? Is Magic Spoon public or no?
No.
Okay.
Dude, these are tiny companies. These are like little.
Okay. Okay. I don't know. Let's say Nike.
Okay. Cool. Good. Now, the first point to make about this, right, is that because these are all like huge companies, they're probably not going to go back. Like Amazon's probably not going to go bankrupt anytime soon, right? Like Apple's probably not going to go back. So like, it's not like you're throwing your money away, right? Like these are perfectly good investments to make,
right?
You know, like these companies are going to be around for a while. So you're not wasting your money. Secondly, because you know these companies well, it's a lot easier to look into their financials and to learn about what debt is and what are assets and different streams of income and things like that. It's a lot easier to learn about it if you already know the company. Like trying to learn. Let me think of an example. Okay, Simon Property Group. You ever heard about them? Even though your name is Simon, I didn't. I actually did not pick that on purpose. Okay, Simon Property Group is a real estate investment trust. And what a real estate investment trust is they're called REITs. REITs, right? Real estate investment trust. REITs are basically kind of like mutual funds, but for real estate. So if you buy a share of Simon Property Group, you're basically buying a portion of this company that runs these like shopping malls and work centers and real estate, right? Now, for you to have to learn how a financial statement works with debt and equity and all this stuff, while at the same time trying to learn what real estate is and how a mall actually makes money and a shopping center, like it's a lot to learn at once, right? Versus Apple, you already know Apple, so you don't need to learn what is iCloud, like what is an iPod or iPhone, like you already know all that stuff, so it's a lot easier to learn the theory behind the financial statements and stuff if you already know the company, right? So I'm a huge fan of like starting with companies you already know and then learning investing based on those companies.
Okay.
So like for example, those 5 companies, you would like dump a little bit of money in each and then you start following them, and that's how you would start getting used to it.
Right.
Before, you know what I mean? Like I wouldn't pick a brand new company you never heard of until you're like much further down the road. Because I feel like that's just a lot of unnecessary difficulty.
Right.
Yeah. Because then you can figure out like I thought Apple. Let me give you an example. Where do you think Apple makes a majority of their money?
Where?
Like what part of Apple's business?
Probably their iPhones, I would say.
Okay. What percentage of their profit do you think comes from iPhones? Like iPhone sales?
Ooh, I don't know. I want to say maybe 50%.
50%.
Yeah.
Okay, see, this example would mean a lot more if I actually knew what the answer was.
Okay.
What about what about their computers?
Their Macs too. Yeah.
Their Macs. What percentage do you think comes from their Macs?
Shoot. I don't know. It's really probably like 25%.
Okay, so now again, I don't know exact answer, but I'm pretty sure that the percent that Apple makes from their Macs is like 5-6% or less.
Okay.
Like super
Okay.
low. It might even be lower than that. Okay, I'm totally making that up. But the point is, learning, like, just because, like I said, it's good to know about the company, right, to learn how to invest. But just because you know the front of the company does not mean you understand the back end of the company, right? Like the fact that Apple, the largest percentage of cash flow, like the source of the largest percentage of cash flow that comes into Apple is reoccurring revenue from like iCloud services and stuff like that. Like paying for iCloud, Apple Music, reoccurring cloud services, which I feel like most people, if you ask them, hey, where does Apple make the most amount of their money? They wouldn't say that.
Right.
You know what I mean? Like, I think a lot of people say like iPhones or Macs or something, which, again, I don't remember the exact percentages, so don't quote me on it, but that kind of drills it. Or for example, like Amazon. Where does Amazon make most of their money?
Right.
Well, people think like, buying stuff off of Amazon.
But it's probably all the digital subscriptions.
They have an enormous income from Amazon Web Services. You know what that is? AWS?
No.
Right. Most people have never heard of AWS. But they got a lot of money from it's basically like data centers. Like running your services, you're running your website off of Amazon. Like, it's what it sounds like, Amazon Web Services.
Oh, okay.
Like it's learning more about the companies that you already know.
Right.
And so being able to dig into those papers, and I don't know, dude, it's just super. Also, it's also super interesting because you learn stuff about the companies that you like that you didn't know about before. All this to say that the best way to get started it does not matter if it's a good investment or not. Like, would I buy Nike right now? Maybe not. It just does not excite me. I don't think they're going to. Like, they're not going anywhere.
Right.
But I don't think they're going to explode anytime soon.
Got it.
So, knowing everything I know now, would I buy Nike? Maybe not. That being said, the point of this is just to dip your feet in, get your feet wet, start learning about it. So then, like, yes, I would tell you, buy Nike and then follow the company.
Okay.
You know what I mean? So, I don't know, man. Like, it's fun, man, getting started and all this.
Yeah.
You have any? So I think that covers a lot of the basics. I'm trying to think. Like, can you think of something that would be considered the basics getting started that we have not covered?
Not yet. I have an idea of what we could talk about the next episode, but not.
Yeah, tell me.
How to look at small or start outs to see if you predict if you predict whether or not they explode.
They're going to do well or not? Yes, we can do a whole thing on that. The short answer is don't.
Not now.
The short answer is no. The short answer is just don't. No.
Oh.
I'm gonna give. Oh my god, I cannot believe you brought this up.
Okay.
Okay. No. Let's.
You want to get into that now or later?
Maybe like a short, like a preview, because it's fresh on my mind.
Right.
Okay. There was a new. I'm not going to mention the name of the company, but there was a new company that just IPO'd. An IPO is initial public offering. IPO, it means when a company becomes public.
Right.
Okay. A company just IPO'd like a week ago. Okay. I'm not, and I feel like most people can guess what it is, but I'm not going to mention the name of the company. It has no product, no cash flow, no SEC. Basically, they became public. Normally, when you become public, you have to go through a bunch of different stages and filters with the SEC to get listed on an exchange. Like, there's a lot of regulatory steps you have to go through to become a public company. Okay. There is also a back way to become public, which is basically you get acquired by a shell company, basically.
Oh.
Okay, which is what this company did. They were acquired by a shell company, which means they were able to skip a lot of the steps that most companies need to go through to become public. Okay.
Okay.
Which isn't necessarily a bad thing, but it's not a good thing either. Okay. So, oh my God, I cannot believe you brought this. This is really funny. Okay. This company is, so it started off sort of sketchy. Okay.
Okay.
It has no product. It does not plan on having a product until 2023.
Okay.
Okay. It has zero experience being a public company. And it's in an industry that there isn't a single successful. It's almost like biotech, but no, it's not biotech, but it's almost like, in the sense that like until you have a product, you have nothing. Literally, all they have right now is theory and good and good PR, basically. Okay. Right. Do you know how much money that company is worth right now? Like valuated on the markets, I'm saying. Like how much people are thinking it's worth on the markets?
Not much.
Just
like
guess.
I don't know, $2.
No, like total, like not per share. Like what's the market capitalization, basically? And we didn't even talk about what that was. But basically, how much is a total company worth if you wanted to buy the whole company right now? Again, with no product, nothing. Okay, absolutely nothing.
Okay, I don't want to say $0, so I'll be nice and say like $20.
No, dude. No. Okay, maybe it's a bad question because you don't have a frame of reference.
Right.
Okay, $32 billion. Okay, with nothing.
Okay, no, yeah.
The only thing literally they have is a plan and a leadership team that is saying that they are that like they're basically telling people that this is what their goal is.
Wow, I would never have guessed that.
They don't even have like a minimum viable product. Like they don't even have a prototype.
Okay.
It's literally yeah. It's absolutely insane.
Wow.
And people are piling into this company. Like this stock has gone up.
Wow.
Almost doubled. Because people are like, oh my God, this is the next big thing, blah, blah, blah. Like it's the most stupidest.
On their word, just like that? Like
Exactly. And I mean there are other elements for sure.
Okay.
But $32 billion on literally nothing.
Wow.
Okay. Here's the thing. You do not need to get into a company right away to be able to ride it to the top. Like you're going to have plenty of time before this company explodes to jump in a few years down the line once they actually have something to report on.
Okay.
So there's almost zero time that I would say jump right into a company right when it becomes public. Like I cannot think of a single company that became public and immediately exploded and never came down where it was a good idea to get in at the time. Like I don't know, like here, like a popular one's Tesla, for example. You know Tesla? Yeah, electric car maker, solar energy, yes. Like super trendy, whatever. You could have bought in. It took them I'm pretty sure like 6 or 7 years to start exploding upwards.
Oh.
Okay? You did not have to buy in on day one. You could have literally waited 5 or 6 years and then put your money in after 5 or 6 years and then make hundreds of percentage points of increase on your money.
Wow.
Okay? Like Facebook. When Facebook first came out, their stock went down by a lot. Okay? And then they hung out there for a while. And then they started going. Like, you don't need to jump in right at first.
Okay.
And I feel like it's this sort of trend where it's like, oh, you want to get in right away to like join the party. They almost make it like a launch party. Like, oh, we're going public today. It's a big party event.
Right.
Like, you should not think of it that way. Total rant on IPs. Like, oh my God, dude, it grinds me when, because like you have and even like. You have no idea how this company is going to act as a public, because being a public company is completely different from being a private company.
Right.
Okay, like the amount of regulation and scrutiny that a public company has to go through is completely different. You know what I mean? Like a private company could almost pretty much do whatever you want. Like you don't need to answer to shareholders. You don't need to have like annual reports, quarterly reports. Like you don't have to do anything.
So why would a company choose to go public? Is it just to get more investors? Money? Okay.
100% money.
Okay.
There's nothing there is almost no way to raise equity like the U.S. markets.
Got it.
But because of private equity, which is basically private equity is basically like private investors, right? Because of the increase of private investors these days, companies can go longer without becoming public because they have access to more money.
Got it.
So, but still, you have no idea how they're going to act as a public company until they are actually public and until they've been public for at least a year or two, like until they've released an annual report. You have no idea,
Okay.
So just especially as a new investor, but even as an investor who's been investing for years, there's almost no instance where I would say, yeah, totally get in on day one.
Okay.
Because honestly, and here's another thing. See, dude, you got me on the roll. Even if you do buy on day one, it's not actually day one. Like those shares were offered first to massive investment banks before they even became public. Like you're not even getting there first. So why even bother to buy? You know what I mean?
Right.
Like just wait, man. Like wait and see. Plenty of years to see how they do.
Okay. Got it.
So yes, long short. Wow, that I did not expect you to go there, dude. Like, I thought you'd have some. I don't know. Yeah.
Okay.
I bring back to the whole market capitalization thing. Probably next episode let's define some basic terms, like what's a market cap, what's a PE ratio, what's a trailing 12-month like price of sales.
Okay.
Like all these little, like for example, a very maybe we should have talked about this in the beginning, but the probably the easiest way to look up a company. No, not the easiest. A very easy way to do it is Yahoo Finance.
Oh, yes.
Right? Just go in the App Store, any store, or even on your desktop or whatever. It's completely free. Download Yahoo Finance, and you can type in the ticker symbol of any company, or even type in the search. Like, just type in Amazon, right? And Amazon will pop up. AMZN is a ticker for Amazon. Or like Apple, right? AAPL for Apple. Yeah. And it'll bring you up the stock chart, and you can see what's the performance of today, last week, a month, a year, 10 years, 20 years. You can see the whole thing. And when you hit this little thing called like more, I think it's like more details or something like that, it'll tell you all the stats. What's the market cap, right? For Apple, it's like 1 trillion. Like it's a lot of money. What's the price to sales? What's the book value? Like all these things, which we'll define on a future episode. But basically, that's how you can like look at an actual company and see its financials.
Cool.
Yeah, dude. Like, oh my god, it's super interesting.
It is. It is.
Super interesting.
Yep.
Cool. Well, I'm almost worried to ask this because last time you asked the question, we went on a whole rant.
No.
Give me another question, Simon. Or do you have any other questions that you think would fit into this like entry like, beginner?
Not as of now, no.
Okay, I'm trying to think. I think that about covers it.
Yep.
We went through just basic definitions, opening a brokerage account, what account to actually open, stocks versus bonds versus funds. Huge tangent and rant on IPOs.
Yep.
And why you don't need to get into an IPO. Yeah, man. I think that's about it, right?
Yeah.
Cool. Yeah. Okay. Well, let's end it
Cool.
there then. If you guys have any questions that you want us to answer on future episodes, reach out to us. We're on social. We're come on the website, runwithchestnut.com. Blah blah blah. Ask us, drop us a line, and we'll try to get an answer.
Yeah.
Simon, I think this was good.
Yeah, a good episode.
All right,
cool
man. See you
next time.
All right,
Later.
Later.